Okay, well, Gautam, Johnny, it's a pleasure to be here. And I think you guys are very accomplished and have done really well in life to have a seat at Oxford, which is awesome. My good friend Guy Spear is an alum. He went to Brasenose. And I spent a few days living in the dorms of Brasenose with Guy and a few other friends, and that was a lot of fun. We had a retreat on the Oxford campus, and I'm biased towards overdosing on shawarmas. And so I found some good shawarmas in Oxford and life was great. So that was a nice experience. The Dhandho investor is, it uses the Patels and their amazing journey with Motels, not only in the US, but the Patels have really done well in the UK as well. So I use that as a backdrop to get some principles and perspectives across. But just to clarify, I am not a Patel. I did not grow up in a motel, and I did not have the life experience. That's the central theme of the book. I was really an observer, and I thought that the Patel experience has a lot of commonality with value investing. And so that's why I use that as the backdrop, because I think it's a story that needs to be told more often. And I think at this point in the US, probably something like 70% of the motels in the country are under Patel ownership. And Patels make up, I would guess, less than 0.2% of the US population. So when this 0.2% comes into the country as refugees in the 70s, and then they end up owning 70% of a fairly large industry, it's a peculiar event and it's a peculiar outcome, and it's interesting to study why that happened. And so that's kind of what drove my interest. And the framework that the Patels used to establish their dominance is a very powerful framework. So the Patels had gone to East Africa, Uganda, etc., more than a century ago. And they'd been actually taken there as indentured laborers, almost like slaves. But because of their Dhandho ways, over a century, they came to control most of the Ugandan economy. So similar type of situation where a very small minority is controlling large swaths of an economy. And in the 70s, when Idi Amin came to power in Uganda, his perspective was that Africa is for Africans. And of course, he's kind of ignored the fact that the Patels were really Africans. They'd been there, they were born there, their fathers were born there and so on, but that didn't quite resonate with Idi Amin. So he pretty much confiscated all their assets and gave them like 60 days to leave the country. And so their businesses were taken over and their homes and properties. So Patels pretty much overnight lost everything. And they were stateless because they were Ugandan citizens. They were not citizens of any other country. So Britain took in quite a large number of refugees from Uganda. Canada did as well. And surprisingly, India refused to allow them to enter. India was at that time reeling with the Bangladesh refugee crisis. Bangladesh had just been formed, so they really had no appetite for more refugees. And so the United States, under Nixon and Kissinger, took a large number as well. And the Patels were able to convert some of their assets into gold and such, and maybe they got out with $5,000, $10,000, $15,000, and that was it. And the motel business seemed to resonate with them because the first need it satisfied is it gave them housing. So these 10, 20, 30 room motels that were built along in the 50s and 60s as the US interstate system got built were a bunch of mom and pops, and those folks were getting older and ready to retire, and their kids really weren't interested in the motel business. So the first Patels who came bought some of these motels, and they bought them very highly levered. So usually like kind of these motels at that time were like 50,000. They were like, 10, 20, 30 room type properties in the middle of nowhere, 50,000, 75,000. And the Patels put up like 5 or 10,000 of cash, and the rest was either owner or bank financed. And they put the family in 1 or 2 rooms. And the motel business is labor intensive. And so the families pretty much worked around the clock, and they got rid of all the hired help. And so they were cleaning the rooms and manning the front desk and all of that. And so very quickly, the Patels became low cost providers. If there was a Patel owned motel in a particular geography, its operating cost was lower than all the other neighboring hotels because they had no payroll. Payroll was zero. And all the others had hired help. So what the Patels would do is they would price the rooms lower than anyone else. So their properties were always almost completely occupied. And while the others, when they try to match those prices, they would end up either not making money or losing money. So low-cost providers gives many businesses a long-term enduring competitive advantage. I mean, we see that with Geico, with Berkshire Hathaway, and you see that with Costco and so on, so Walmart and so on. So low cost will give you, even with Nucor, for example, with their mini mills, low cost gives you a huge advantage. And because they were a low cost provider and because their financials were healthier, they lived a very basic frugal lifestyle. Most of them were vegetarians. Anyway, they couldn't go out to eat. In the 70s in the US, your choices for eating as a vegetarian were very, very limited. So basically they ate their simple meals. They had their simple rooms in their hotel. So they had no housing costs and their living costs were low. So their savings rate was high. And what they did with the savings was they started to buy more motels. And so the family would take one family member and move them out into another motel. And then that person would get going with that and, cascade that over time. And it worked well. And the end result is what we see today, which is they completely dominated an industry and they took over. So that story, I think, has a lot of resonance with value investing. Because in investing, what we are trying to do is we're trying to get a unfair advantage. There is some quirk with some company where they have so taking a step back, capitalism is brutal. It's a dog-eat-dog world. And one of the things you may enjoy is there is a video on YouTube, which was, I think, maybe put up 5 or 6 years ago. And the title of that video is Competition is for Losers. And I think you guys will enjoy that video. It's a video recording of Peter Thiel teaching a class at Stanford Business School. He used to teach a class on startups and entrepreneurship. And I think the video's got a huge view count, and I think it's an excellent video. I don't know whether Peter Thiel would like that video out there now because he's become somewhat, notorious. But what Peter says is that if you look at most businesses, or almost all businesses, you can put them in 2 categories around the planet. There are a small sliver of businesses which are basically monopolies or oligopolies, and they have very strong competitive advantages. And then there's an overwhelming majority of businesses which are basically really tough businesses to be in. And so 99% of capitalism is these really tough businesses, and maybe 1% or less is these, monopolies or somehow insulated business. And Peter's point to his students was that there is no point following the masses of capitalists and either working at or founding a business that is dealing with all these competitive forces. We want to be sitting there with monopolies, and that's how we make a lot of money. And I think in investing too, basically what you're looking for is some kind of an edge that the business has that is an enduring edge. And if you can invest in a business which has that edge at a reasonable price, good things will happen to you. So that was basically the genesis of the Dhandho investor and why I use the Patels and so on as my foil, if you will.
That makes sense. Thank you. Thank you for clarifying and explaining that. Mohnish, I'm curious, when you started out investing, was it easier to find these 1% of monopolistic companies than it is today? Have markets become more efficient and have more people kind of understood what to look for? Or do you think that your hit rate has kind of always been the same?
Well, actually, the monopolies, even if they are 1%, there's 50,000 listed businesses around the planet. So even at 1%, you would have 500 of these, awesome businesses. So actually, identifying awesome businesses is not a problem. There are many, many great businesses around. Okay, I mean, Amazon's a great business and Alphabet's a great business and Microsoft's a great business. And what the Patels have done has been a great business. So actually great businesses all around us. And it's also not that hard to be able to tell that a business is great. And that's another point that Peter Thiel makes in his talk. He says that the monopolists go through extreme lengths to convince you that they are not a monopoly, that they exist in very competitive spaces, because they know that if they are a monopoly and they beat their chest about it, they will attract unwanted attention. I mean, like Facebook doesn't really want the US government to think it's a monopoly. And Google really doesn't want anyone to think it's a monopoly. So the monopolists try really hard to convince us, oh, poor me, I'm not a monopoly. Okay. And the loser 99% of competitive businesses go through extreme lengths to convince you that they are a monopoly. They try to convince you that I got the secret sauce. Look at me, I'm awesome. Okay. So the monopolists basically are telling you, I'm just Joe Public, man. I got nothing going on. Don't look here. Go keep walking. And the competitive ones are beating their chest saying, no, come to me. I have this awesome business. And let me tell you why it's so awesome, right? But I think that for an investor to figure out whether a business is great or not, and whether it's a monopoly or not, is a relatively simple exercise. Not that hard to do. Because I think a simple thing you can do is if you make a list of all the products and services and places that you shop at, okay, you will find the overwhelming number of those are monopolies. Okay, so, do you use an iPhone? Guess what? It's a monopoly. Okay, do you shop at Amazon? Okay, and who sends you your utility bill? They're all monopolies. Okay, so identifying monopolies is relatively easy. You can identify them by looking at companies that you're really familiar with, that you're a customer of, a client, or whatever. The other way you can get to understanding a monopoly is looking at the numbers. Their financials will scream out and tell you, I'm a monopoly, even when they just want you to go away and not look at them. So it's not about finding great businesses. It's easy to find great businesses. It's about finding great investments. And the two are different. So once we identify that a business is great, that's awesome. We can collect a list of those. And then we have to go to the next level, which is try to find ones which somehow the market has not figured out. And somehow there's an aberration where the price does not reflect the great underlying economics. And then you're off to the races. Hallelujah. It's great. So that's what the game's all about. It's easy to sift the great from the not so great. But then the second piece, which is it a good investment from that subset list? That becomes a little bit harder. But as my guru and mentor behind me, Charlie Munger, likes to say, why should it be easy to get rich?
That makes sense. Mohnish, I'm curious, has it become easier, harder, or the same level of difficulty to find great investments as it was 10, 15 years ago?
So humans vacillate between fear and greed. As long as there are humans making investment decisions, we will have mispricing of securities. And the mispricing can be in both directions. They can be ridiculously overvalued and they can be ridiculously undervalued. So from time to time, humans get very euphoric and they get really excited about certain assets and classes and such. And, they get overheated. And many times things are not of interest. So I would say that if one is a bargain hunter looking for great businesses that are underpriced, there's always a set of them somewhere that fit that criteria. The problem is that the ones that fit the criteria aren't the easiest ones to invest in or to actually even convince yourself. So for example, in 2019, I made an investment in a company in Turkey. Okay. And at that time in Turkey, and even till today, from then till now, their backwards macro policies has decimated the lira. The Turkish lira, pretty much for the most part, has collapsed. I mean, in 2019, when I was looking at Turkey, it was under five, a dollar was under 5 lira. Now for a dollar, you can get more than 9 lira. So it's a pretty significant move in a couple of years. And the lira will continue to weaken because of their backwards policies of how they think about, the exchange rates and such. So anyway, when I was looking at Turkey, I found, and even now I find Turkey is one of the cheapest markets in the world. And the reason it's cheap is because everyone and their brother just wants to exit. They just do not find it comfortable being there with Erdogan and company. And they just don't want to be there. And if everyone is rushing to the exits, the odds are pretty good that you might find a bargain or two. And so, for example, in 2019, I found this really incredible monopoly business. Peter Thiel would be proud, where Reysaş, this company in Turkey I invested in, they had 12 million square feet of prime warehouses. They have a bunch of other businesses too, but they had 12 million square feet of prime warehouses, 99% leased to Amazon, IKEA, Carrefour, just top brand, 10-year leases, inflation indexed, rent adjusted every year. And the market cap of the company was $20 million. And the debt the business had was less than 200 million. Okay. So if you take the entire 220 million, whatever, 220, 230 million, whatever, let's say it's 240 million. Let's make the math easy. Okay. 12 million square feet. It's $20 a square foot. Okay. Anyone would be willing to buy those 12 million square feet in about 5 minutes from them for around $75 or $80 a square foot. Like the deal would just happen like that. Okay. These are very prime properties with class A tenants with pristine credits. Okay. And so if you sold this 12 million square feet, you would end up with like $1 billion. Okay. And then you pay off the 200 million and you'd have about 800 million. And the market cap was 20 million. Hallelujah. And then we come to the pesky issue of rampant inflation and rampant devaluation of the lira. And I looked at it and said, this is a complete non-event. Because if inflation goes up, then cement prices go up, land prices go up, the replacement cost of those warehouses goes up. So instead of $80 a foot, they'd be at $120 a foot. Okay. So who cares about the inflation? Bring it on. Okay. And if the lira weakens, implicitly what is happening is that the properties would appreciate in lira, but in dollars, they would stay similar. This was the theory I had. Okay. That one is I was buying at like 4% of liquidation value. You know, I was buying $1 for 4 cents. Okay. Nobody was interested. Okay. I thought I wouldn't get much stock. The rush to the exits was so intense that I ended up owning a third of the company. Well done, Mohnish. Well done. I think I outdid even the Patels. I don't think the Patels ever picked up a property for 4 cents on the dollar. And my last name isn't even Patel. Okay, so now fast forward 2 years. The lira went from 4 and change to 9 and change. In dollars, my investment is up 6x. In dollars. In lira, it's up 10x. Who cares about that? That's irrelevant. But in dollars, we're up 6x. Okay. And basically, even at 6x, we are still undervalued. We've only gone to 24 cents on the dollar, from 4 cents to 24 cents. You know, still have another 4x to get. And the company is not sitting idle. In the last 2 years, they raised the intrinsic value of the business because they did a bunch of smart things. They put solar panels on all their rooftops. They're now going to be generating like 50 megawatts of power with Turkey's new net metering laws, which they sell to the government at the same price that the government sells electricity. And solar panel prices have dropped like crazy. And Turkey has no fossil fuels. So their electricity prices are indexed to oil. And so those prices keep going up. They've already spent the money on the panels and they keep getting more money. So the value of the business went up, I think, another 200 million in the last 2 years on a 20 million market cap. Okay. So we don't need to be very smart. We don't need high IQs. We don't need high grades from Oxford. We just need to have basic common sense. That's it.
That's a really good answer.
You didn't even need a calculator for this, and you definitely didn't need Excel.
I don't have a calculator or high grade, so I just got 2 things right. Some of your earlier arguments about what makes a value investor a good value investor could be applied in reverse. You could also say that a value investor would be able to identify when a company is very overpriced and when there's too much greed. So with that in mind, why aren't more value investors like yourself, Buffett, or Munger active on the short side?
Yeah, I think shorting is one of the dumbest activities you can engage in. And Roaring Kitty gave you a great lesson this year on why it's a dumb activity. You know, I just finished reading this book, and I actually sent it to Warren and Charlie, and I really enjoyed it, you know, The Antisocial Network. And the guy who wrote it is the same guy who wrote Bringing Down the House, you know, the MIT blackjack team that cleaned up all the casinos, and then they made it a movie. He rambles a bit, so I think this is not one that you sit and underline. I think this is a book that gets skimmed, and I think he wrote it from the point of view that it becomes a movie someday. One day we will see Roaring Kitty on the big screen. instead of just at a congressional hearing or in his basement. So anyway, the thing is that shorting, the economics make no sense, because if you're wrong, the answer is bankrupt. You've gone bankrupt if you're wrong. So there is no limit to how much a stock price can rise, as AMC and GameStop, etc., have shown us. The maximum you can make in a short position is you can double your money. And the maximum you can lose is everything. So right there, why would you want to engage in that type of a bet? If you went to a racetrack and someone said, listen, man, if you pick the right horse, you get 2x. You pick the wrong horse, you get nothing, and we'll take all the money you have. You'll never make that bet. So shorting just seems like a really difficult. So I think the nature of investing, that there are two major advantages you get as an investor. Even though you guys don't play baseball, maybe you know some of the rules. So one is that Buffett says that in investing, there are no called strikes, right? So basically in baseball, which is a less civilized version of cricket, if you get 3 strikes, you're out. In cricket, you can just sit there and let 100 balls go by. As long as, they don't hit your stumps or your legs or whatever, you're in good shape. And that's fine. But in baseball, you have to swing. And if you miss 3 times, you're out. And so the rules are kind of more difficult. But in investing, there are no called strikes, which means that you can let 1,000 balls go by. So you don't need to have an opinion on everything. You just need to have an opinion on a very small sliver of the planet. And so one can live a very healthy life and a very wealthy life without ever shorting a stock. The inversion to the stock shorting issue is I don't see any short sellers in the top 10 positions of Forbes. Where are they? Well, they lost their shorts. That's where they are. So we can do well without shorting.
That checks out. Mohnish, I'd like to abstract a little bit away from the specifics of investing to some broader questions. So one of the things that both you and Buffett talk about is managing your psychology. And one of the ways in which you do this is you have an inner scorecard, like a checklist of the things that are important to you. If you're comfortable, would you be able to tell us what's on your inner scorecard? And on top of that, would you be able to tell us how and when you knew that those were the right things to have on your inner scorecard?
Well, I think the inner scorecard is it's not a static kind of template, if you will. Basically, like when I met Buffett for lunch with my friend Guy Spear, he said to us that, would you rather be the greatest lover in the world, but known as the worst, or the worst lover in the world, but known as the greatest? And he said that if you know how to answer that question, you've got it made. Okay. So the inner scorecard for all of us is very straightforward. We always know what the internal correct answer is. We know that. We have a conscious and we know that. It's just that it's very tempting to live life with an outer scorecard, which is if people think I'm the greatest lover, well, let them think that. That's awesome. And that would be an outer scorecard way of living life. And so all you have to do is that when you encounter distortions between the inner scorecard and the outer scorecard, focus on the inner scorecard. And for each different type of, activity or conclusion or whatever you come to about something, your inner scorecard is really what should guide you. So, for example, if my fund is up 30% next year, everyone would be saying, oh, that was awesome. But what I have to do internally is ask myself, well, what was the risk I took? Was it risk-free? Was it truly a great return relative to, and was it the best opportunity cost in terms of where I could have put the money? These are questions I can answer better because I have underlying data. a lot richer underlying data. And so the easiest person to fool is to fool yourself. And you really have to make sure you're not fooling yourself. So an inner scorecard is a really important, it's a really huge advantage in life to live your life with an inner scorecard. What will happen is that if you live with an inner scorecard, you will become more trustable. You'll become more trustworthy. And if a lot of humans are willing to put a lot of trust in you, that's a starting point that's going to give you a huge edge in life.
That's a very, very, very thought-provoking answer. Thank you. I was hoping you could tell us a little bit more about the things you've learned from knowing Buffett personally that you would not have picked up from reading his books.
I don't know Warren that well. I mean, I've met him a few times, but I would say that I'm acquainted with him. I'm not a friend of his, but it's been interesting to observe him at close quarters sometimes. I think that's been so. I think the thing about Warren is that Warren is and a lot of things about Warren Buffett you can get to without ever knowing him. He's one of the most open books you can think about. So, for example, and one of the things about humans is that the way we are at the age of 5, our personality templates, our likes and dislikes, our traits, between our genetics in the first 5 or 6 years of life experience, they are hard-coded. Between the age of 6 and 96, humans do not change. And once you understand that and you take that as a gospel truth, it becomes really easy to figure out which humans to interact with, which humans to have as your friends, and that sort of thing. So that's one data point, which is humans basically don't change. The second data point is that there's a gravitational pull. So if I hang out with people who are better than me, I'm going to get better. If I hang out with people worse than me, I'm going to get worse. So given that humans are not going to change, once I know the nature of the human, it will be wishful thinking to think that you're going to change them or something is going to improve in them. It is what it is. So being extremely picky on who your friends are is going to give you a huge advantage in life. So in the case of Buffett, he used to go to the Ak-Sar-Ben racetrack in Omaha when he was 9 or 10 years old. Ak-Sar-Ben is Nebraska spelled backwards. And what he used to do is at the end of the races, he'd pick up all the tickets that were on the ground, because they would be drunks who'd won something, but they wouldn't even know they won. They just tossed the ticket. And he'd go through each and every ticket to see if there were some tickets that were actually winning tickets that they were discarded. And he would find some winning tickets. But then he was too young to go to the window to collect. So he sent his Aunt Alice to collect for him. Okay. And he did this every weekend. Okay. And he was so it's a very dogged person who's going through that exercise of, because you would go through 500 tickets and find one, or 1,000 and find one. It's a needle in a haystack. In his mid-20s, he was going through the Moody's manuals. The Moody's manuals are these really thick manuals, which had like 4 companies, fine print on each page. And he was doing a quantitative assessment of thousands and thousands of companies. In fact, he went through the Moody's manuals 2 or 3 times. And in going through those, he found a bunch of extreme bargains. I don't think any of them were at the level of Reysaş. I still am one up on him. Okay. I don't think he found anything in the Moody's manual that could, and the reason for that is Reysaş is actually increasing value and whatever. But he found a bunch of, companies with a 15 million market cap making 25 million, something like that. Okay. So he found a bunch of these things. The activity that the kid at Ak-Sar-Ben was doing and the 25-year-old were doing are identical. Okay. It's the same activity. And then a few years back, Guy and I were visiting him in his office. And I saw that on his desk was the Japan Company Handbook, which is kind of like a value line of Japan, except it's just very quantitative, fine print, 2 companies per page, every listed Japanese business. And he was going, and this is, Berkshire's got 100 billion plus in cash. He's not going to move any needles by finding some company that's worth 25 million but should be worth 50 million, or worth 100 million should be worth 200 million. That's Berkshire can't do anything with that. But the kid is programmed that way. Okay. And so this was when he was maybe more than 80 years old. Okay. What he's doing at 9 and what he's doing at 25 and what he's doing at 80 are the same thing. Okay. And I actually, it was a coincidence, but I was going through the Japan Company Handbook at about the same time. I had the exact same edition as him. And I told him, oh, Warren, listen, I can make this faster for you. There are some companies I already found. And I took his Japan Company Handbook and I dog-eared some pages for him. Okay. I think he might have been horrified that somebody just, I didn't even ask him, oh, may I dog-ear it? I just went ahead and did it. I was so excited about it. And then, a lot of the dog ears were in the back of the book. He says, usually all the good stuff is in the back. So what I'm trying to say is that Warren is a very unusual person, but I think there are a lot of lessons to learn from him. I think most entrepreneurs, whether you go look at Sam Walton or Warren Buffett or Howard Schultz or Jeff Bezos, they're very intense in their pursuit and they're very singular in their pursuit. And when you have those traits, you're going to do very well. So a lot of people want to be Buffett. A lot of people want to clone Buffett. If you don't have the personality who would really enjoy picking up those tickets in Exarban, you're not going to get to being Buffett. So if somehow you have the personality and you can't do anything about it, you either have it or you don't have it. It's pretty binary. It's not something you can add on. Okay, there's no add-ons that happen. So I think the important thing for humans is you really have to understand who you are. And once you understand who you are, then you have to have behaviors that maximize the talents that you have. And your talents may be very different from Buffett. So you have to focus on those talents and those behaviors then.
That's a fantastic answer. Thank you for sharing that, Mohnish. I have one final question, and then after that, we can do some Q&A if we have the time. No worries if not. My final question is, I think, one that like a lot of us as students and as young people struggle with. We haven't had the experience or the time in our careers to have had mistakes and learn from them. So if you could compile all your years since you were back at university and think about the most important things that you've learned that you wish you had picked up earlier, what would they be if you could distill it into maybe 3 top things?
I would say that without failure, there's no success. So it's 2 sides of a coin. So I think generally speaking, when you look at people who've been very successful and you kind of peel the onion, you'll find that there were a lot of failures along the ways. And without those failures, those successes wouldn't have happened. Now, we are probably better off where we learn not from our mistakes, but from other people's mistakes. And if we can do that, then it's a lot less painful, right? But the nature of life is that our own mistakes get seared in deeper and the lessons get seared in deeper. So in general, it is more difficult to learn from Warren or Charlie's mistakes and sear it in than it is from our own mistakes and sear that in. One of the things, I think Charlie says we're old too soon and wise too late. Last year, for example, when I first started investing in the mid-90s, I was trying to find these businesses with these long runways and, set it and forget it type of thing, like what Buffett had done with Coke or Amex and so on. And I found a bunch of those and I did really well. But then 99, 2000, the dot-com bubble was getting pretty intense and I was very concerned. And so I switched to Ben Graham, looking at businesses which were not necessarily great businesses. but they were very cheap. And there was downside protection. You could make some money, kind of what Peter Thiel is saying not to do. And that did really well. I think from 99, probably, if I had been smart enough to switch around 2012 or 2014, that would have been great. But I got so used to doing that, finding these bargains. It's a very natural, comfortable place to be. That I realized last year when I was studying, there's a book called Richer, Wiser, Happier, which came out earlier this year. It's a great book. And chapter 6 is on Nick Sleep, who's in London and who's done really well as an investor. In fact, I think if you Google Nick Sleep, you can pull up his letters. They're well worth reading. And I realized that Nick had done really well by identifying some great long runways and then just leaving things alone. No activity. So when he shut down his fund, he had 3 stocks. He put all his money in: Berkshire, Costco, and Amazon. And I think he's outperformed pretty much anyone else, no matter what they were doing, because Amazon's just done so well since then. And so I realized that actually I needed to go back to the engine, which is buying these great compounders. And I started to make my journey back. So I would say one of the things, if I could fix it, is that I shouldn't have abandoned the compounders as early as I did. I remember in 2002, I was taking a class at Harvard Business School, and we were doing a case on Amazon, and it was a case on Joy Covey, who was Amazon's CFO. Joy has actually unfortunately passed away. She had a biking accident, but wonderful lady. But this case was about her. She was the CFO at Amazon. And I was so impressed with Joy, and I was so impressed with someone like Jeff who would hire someone like Joy. And at that time, Amazon stock had collapsed. It had collapsed down to $10 a share. And I put 10% of my fund at the time in Amazon at $10 a share. And very quickly it got to 14 and I moved on. Okay. Very dumb. Okay. There can't be things that are more dumber than that. And that's like a 330x that got blown away. And I remember at that time I was managing about maybe 70, 80 million. So maybe even if 5 million went into Amazon at $10, 300 times 5 million is $1.5 billion. It wouldn't have mattered what happened to anything else, but we live and learn. And so life goes on. Life is great.
Thank you for sharing that. Mohnish, it looks like we're up at the end of our hour.
Why don't we take some questions? Yep. And if you guys are out of time and want to leave, feel free. So we'll go for a few minutes and see how it goes.
Perfect.
That's okay.
Okay. Well, before I hand over to Johnny, I just want to say thank you again. It has really been great speaking to you. And thank you so much once again for coming to Oxford Alpha Fund. It's a real honor for us. So Johnny, do you want to come on and take over the Q&A?
Awesome. Thanks so much, Captain. Yes, so guys, thanks for sharing your questions in the chat. We'll try and cover a few of them. Mohnish, we don't want to take up too much of your time, but yeah, it's the same as Captain. Thank you so much again for the talk. And maybe if you don't mind, a quick question from me before we move into the others, just maybe on like investing psychology or the sort of thought process which goes into making one of these investments. So say the sort of Turkish warehouse investment, when you're thinking of putting like your capital on the line here, and you're thinking, I've got a potential 25x investment in front of me, no one else seems to want to touch it. What am I missing? How do you sort of overcome that fear of thinking, I must be missing something, surely it can't be this good? How do you sort of get beyond that stage, I guess, and into the one where you can, you just say, everyone is wrong, I'm willing to make a bet on it? Yeah, just curious to hear about this psychology.
I think that was like complete disbelief when I first saw it. I remember there's a good Turkish friend of mine who I just told him he's a wonderful value investor. And I said, listen, let's just visit all the companies in your portfolio, because I know his the way his brain works. The unfortunate thing with him is he's too overdosed on Graham and too underdosed on Munger, but I'm working on that. He's a work in progress. In spite of the 6 and 96 rule, I'm hoping there's some possibility to tweak him. We'll see. So I remember I told him, listen, are these guys crooks? Is this like an outright fraud? And I spent an afternoon with the founder visiting these warehouses. We went one after the other. So they were real. I mean, they were real. There was a very strong sense of pride in what they had. And I could see that the company did a poor job of laying out its story. And they didn't I still don't think they fully understand or appreciate the importance of educating your investors. They tend to do a not so good job, in my opinion, on that. So I could see that the value was there. I repeatedly asked my friend, what am I missing? Why would this thing sell at this price and this sell at this price? And then the whole pie is selling at nothing. And he said, I can't tell you. There's no answer I can give you which would. So I said, I can't really find anything. I tried to find if there was a fraud, and I could see why. So this company, a 20 million market cap, would be so below the radar of almost any institutional investor. They wouldn't even look at it. And even if they looked at it, the financials were so convoluted, they wouldn't be able to make head or tail of them. Because the thing is that the value of the warehouses doesn't show up in the finances, because that's book value with depreciation. They've been buying these things for 30 years. And it's in lira. So, historic lira pricing is nothing to do with current market value. So the published financials were not going to help you figure out what the value of the business was. It wasn't there. And so I could see the reasons why people would miss it. But this was a pretty glaring miss by a lot of people. But Turkey has many, many businesses, not to this extent, but it has many businesses which are widely mispriced, just because it's such a difficult place to be with all the backwards policies they have.
Awesome. Noted. Something to keep in mind, I guess, similar to Gautam's thing of things to learn early on and keep in mind. Some really valuable advice for everyone there. So we have had a few questions in the chat. So I saw Julie asked a question about sort of switching from sort of towards more quality-oriented investing, which I guess we've already touched upon. And we will have to probably veer away from any questions on current holdings. Mohnish, I think we can't touch on, there's a question here about like, why did you sell Shinnikin and buy more Alibaba? I think we probably can't talk about that.
Yeah, I would like to duck those questions.
Yeah.
I'm happy to answer them at some point when we're not, in those talks.
So Luke, I saw you asked a question. Would you like me to read it out, or do you want to maybe ask it yourself?
I was just reading through the blog you had up, and you were talking about your cloned portfolio and the way it performed. But I saw like a lot of the guys who had really performed well in sort of like the 2000s and like earlier than that had like closed their funds, and their funds really haven't performed as well recently. And I was sort of wondering when you decide to sort of cut your losses if you previously thought someone was performing well, because I guess you might have some kind of emotional attachment, or like if they have one bad year, I guess you will let it off. But like at what point do you sort of that maybe the skill is gone or they've lost their edge or something like that?
Well, I mean, I think cloning is a very powerful mental model, and I don't fully understand why, and I've been a student of cloning for more than 33, 34 years. And it's given me a huge edge to understand as much as I do about cloning, but I still don't understand much. One of the main things I don't understand about cloning is why so many humans have an aversion to it. What I do understand is just a small sliver of humans embrace it and most don't. And so the ones who do embrace it get an edge. But in investing, I think cloning is a approach you can take as a starting point of research. So if I find that I respect some investor and understand how their brain works, and I look at their portfolio and I find some companies, and once I look at their portfolio, from then on, the cloning piece is history, and I have to turn my own brain on. So it's just a tool to get a shortlist. It doesn't really matter what that investor does in the future or in the past, or whether they've lost their way or whatever has happened. You're looking at a specific position they've made, and you're just using it as a way to reduce the funnel of stocks to look at. So if you identified, 5 or 10 great investors, and you just spent your time looking at their portfolio, that is a way better way to invest than throwing darts or running some, quantitative screens or whatever else to get a short list. Because at the end of the day, investing has a basic problem. The basic problem is the data set is too large. There are 50,000 public stocks in the world. Even if I spent all my time on them, I would never be able to become an expert on even 5,000 of them, or even 500 of them, or even 100 of them. Okay, it's just the data set's too large. So we need some way of culling the data, and cloning is a great way to cull that data set.
Thank you.
Awesome. Thanks, Mohnish. So we have another question here from Michal, but that's also related to sort of current holdings. So sorry, we'll have to skip that. I have one more from Harry as well. So Harry's asking, maybe this is sort of to do with the throwing darts idea. So Harry says, considering how studies show that statistically only about 55% of investment decisions are directionally correct, why would you call someone with a good track record an investment expert and not just an extremely lucky outlier?
I didn't fully follow the question. Can you just repeat that again?
Yes. So Harry's asking, considering studies show that statistically only 55% of investment decisions, I think what he means is investment decisions by investment professionals. Why would you call someone with a good track record an expert and not just the lucky outlier?
I think so. I think investing is one of the broadest disciplines you can engage in. The kinds of factors that affect the future performance of a business are numerous. They cross boundaries of different disciplines. And so one really has to be kind of a, Swiss Army knife kind of thinker of different ways. And the world is a very uncertain place. So if we are trying to figure out what a business looks like 5 years or 10 years or 15 years from now, by definition, that's going to have a high error rate. There are so many variables that can change those outcomes, right? And so John Templeton said that even the best investor will be right only 2 out of 3 times. And if your batting average is 65%, that's the top end of what you can expect as a batting average. If I looked at every acquisition Berkshire Hathaway did, they may have done maybe 100 acquisitions in the last 50 years. A majority of those acquisitions, I don't think worked. This is Warren Buffett making these acquisitions, supposedly the best investor of all time. And there were lots and lots of bets he made on retailers that did not work. So when I look at someone like Warren Buffett, and I look at his track record when he's bought retailers, it's a terrible track record. When I look at his track record when he's invested in banks, it's a perfect record. He's never lost money. But he's invested in airlines, and that hasn't worked so well. He's invested in retailers, and that hasn't worked so well. In a number of areas that he went into, it didn't work so well. But I gave you the extreme example of my investment in Amazon. If I had just kept that investment, it was just 5%, and the other 95% was all mistakes, and they all went to zero, it wouldn't have mattered. Okay, so in that case, it would have tolerated a 95% error rate and still had an incredible outcome. So the interesting thing about investing is because the returns you can generate from some businesses are so asymmetric with the risk taken that this is a business that can tolerate a pretty high error rate. So one should be under no illusions that one is going to be right all the time, or even right 40% of the time, or 50% of the time. As long as you are patient, very patient, as long as you stick to your circle of competence, invest in things that you understand well, even if you're patient and stick to your circle of competence, you'll still have an error rate like Buffett did. But it won't matter. He still became the wealthiest guy on the planet. It didn't really matter. Mistakes are part of the landscape. We embrace them. We learn from them. Don't try to learn too much from them. And we keep moving forward. So shall we wrap it up? Maybe one more question?
I think, yeah, maybe we're sort of running towards the end of time, but I've had quite a funny one from Metan here. I think this is a sort of nice, light-hearted way to wrap up the chat as well. So usually we'd wrap up with a sort of like advice to students thing, but I think this is better. So Metan is asking, who does Guy Spier admire more out of you and Buffett?
Who does Guy Spier admire more than Buffett or me?
Yeah, sorry, who does he admire more out of yourself or Buffett?
I don't know. The thing is that what's happened with Guy is that he comes with me sometimes on my escapades to India and when I'm meeting all these different Indian companies. And a few years back, the great thing about him is that he takes in a lot of data, but he hardly acts on it. So his propensity to make changes in the portfolio is very low. And that's a huge edge in investing if you have high degree of patience and such. And in fact, he's told me once, I don't trust myself to make decisions. So I try to make as few decisions as possible. We were visiting this company in India in 2018 or 2019 called Indian Energy Exchange. I felt like out of maybe 200 plus management teams that I had met in India and companies I'd visited, IEX was by far the best, highest quality business, very high quality management, and an incredible business model. And it was ridiculously expensive. Okay. And basically they're an energy exchange. So at that time, about 3% of India, the electricity was flowing through them, and they collected about a 1% fee of the amount transacted through their servers. So they had no costs. So about 70% of revenue was net income. And that 3% was going to grow pretty spectacularly. And India's per capita energy usage also would grow spectacularly over time. So there was a huge tailwinds for a long time. Because it was such a critical asset for India, foreigners were not allowed to buy more than 5% of the company. So Guy hates businesses like Reysaş in Turkey. I cannot get him to even come with me to Istanbul, okay? Much less ever invest in some warehouse operator in Turkey. But he was all over IEX. He loved IEX. And I think he bought like 4.4 million shares. I think at that time they were like $2 a share or something. So he maybe invested about 9 million. IEX has gone bananas. The business is going crazy and whatever else. It's up like 5-6 times since then. And so now I think for him, IEX has become more than a $50 million position. It's a significant portion of his fund. It might be one of the largest positions in his fund. And I think he's torn between, is Mohnish the best or is Mohnish God? He's vacillating somewhere between those two. So I don't think if you talk to Guy Spier, maybe you should bring him on, that these days I think he's created like an altar to Mohnish, and he worships at that altar. I mean, like last night, I think the IEX price went up at one point 20% in a single day, So but they've got some incredible tailwinds. And thankfully, I was also able to buy some IEX in spite of my reservation. In fact, I used to own 4.99% of the company, and I was very dumb when I sold during COVID, but we still have a good amount. And so similar position to Guy, I think. So it's worked out great. But I think Guy maybe admires his parents more, but I think he worships at the church of Mohnish, especially after
Well, if ever we have a Guy come on as a speaker, we'll make sure to ask him whether he has one of these Mohnish altars at home.
Yeah, and I think maybe you should surprise him and start the conversation in Indian Energy Exchange. It'll bring a big smile.
Awesome. Well, anyway, I think with that we probably are at time. I know we've run over a bit, but thank you so much, Mohnish, for speaking with us. That was such a useful conversation and a lot of really valuable advice for everyone here on the call to take home, especially as a lot of us sort of begin careers in investing. One day trying to maybe replicate this a small degree what you've done, Mohnish. So yeah, just on behalf of everyone, on behalf of the fund, thank you so much for coming down. And yeah, we hope to keep in touch as a society going forwards.
Yeah, well, I very much enjoyed the session, and I think, like I said, you guys have a wonderful part of the world and a wonderful institution, and I wish you all the best. So thank you very much.
Thank you, Mohnish.
All right.
Okay. Have a good evening.
Thanks so much.
Bye.
Okay.